Welcome to Subramani. This post, the content for this post comes from James Altucher's thread on what the Fed does to regulate markets, or whatever it pretends that it regulates markets. Says the interest rates coming down to zero, or moving interest rates up and down, is not the reason why the market is changing, because I think old economists must be believing that when interest rates go up, people will withdraw money from the market and put it into banks so that they can get better rates of interest. That's true, but today I think the worry is not about interest rates. The worry is the amount of money shrinking. Therefore, that is more scary for people. So when you think the Fed is going to shrink the money supply, the markets will go down, because if there's no money, people can't invest. So all those deals where people borrow in the US and invest in Japan, or borrow in US and invest in India, all those trades are likely to be affected. So I'm going to read from portions of what he has written. So he said he says in 2008, the Fed is there to protect the banks, right? To make sure that the banks don't go sink. So it is not to protect you that the Fed exists or the RBI exists, but to protect the banks, because if there are no banks, there will be no RBI, right? I mean, I'm exaggerating, but yes, banks are to be protected, not you, the individual, right? The government of India at least does not send money to you saying, oh, you got an EMI problem here, next 3 EMIs we will pay. No, that does not happen. You have to pay your EMIs. They will say you need not pay for 3 months, but remember, that also did not come free. It came with the fact that you had to pay interest during that period, and so whether if you didn't pay the EMI, you paid interest on that. That's all. It's not that yes, it was a favor that your cash flow was postponed, but you still paid for it. It's not the government waived it for you. And I'm not even getting into whether we should have. So here is the James Altucher's thread, which says in 2008 they started buying the US T-bills again to protect the banks, and the buyers would put money in the banks, increase the reserves, and the Fed would pay interest to the banks, and therefore even today that it gives the banks a lot of money. So the Fed did the same thing in March 2020, and they printed trillions of dollars. The history is 40% of all unprinted money happened since March 2020. All the money printed in the US, 40% happened since March 2020. So last 2 years, 40% plus of the currency of the US was printed in the last 2 years, right? So they largely boost the economy by putting more money into the hands. And you heard Alan Greenspan speak about helicopter money. Just go and shower money all over the place and the economy would improve. So largely we are worried that the government or the Fed will reduce the cash available in the market for people to play around with, and therefore the market is falling, not because interest rates are going up. Well, that's for you to decide. But in 2009, when people saw this, they created something called the Bitcoin. I mean, this is a side thing which I am telling you, that therefore a Bitcoin was created, and it was only in 2009. So it's just a 13-year-old product. And very important to note that the central banks bail out banks and not bail out individuals like you and me. But why is Fed now increasing interest rate? Does it really help? Does Fed or RBI does not know what is going to happen? It is not going to just increase interest rate. It is threatening to reduce the supply of money, and threats work. When there is a threat that there is interest rate is going to go up, therefore supply of money will go down, therefore it is worth selling, you and me will say, okay, let me be the first, right? The very simple rule of panic. If you must panic, panic first. So you get the best. So you feel metal prices are going down, okay, let me go and short metal index, or let me go and at least sell off all my metal positions, whether it is giving me a dividend yield, whether it is good or bad, whether it has already been beaten down, whether it is above the 200-day DMA, doesn't matter. There is going to be a problem in metal, so let me sell metals. So aluminum prices are falling, therefore I should sell aluminum shares. Steel prices are falling, or you say, oh God, the whole metals are falling, so let me sell everything that I have, right? So is the Fed going to really do some of the things that it is saying? The answer is no. because if the Fed really shrinks the cash flow that much, then you'll have your S&P, BTC, everything going down and going down dramatically. So is the Fed stupid enough to do this? Answer is no. But it says it's very simple. The very fact that it threatens, right? Any threat is greater than the actual action. So the threat is driving down the share prices. Is the Fed stupid to do this? No. Is the Fed going to do this? No. But the Fed is going to keep threatening that it is going to do. Maybe it will do one more interest rate hike, but beyond that it will not do. It knows it should not be killing the markets, but yes, it will keep saying that we will do. So yes, that threat will work. So there will be maybe one more rate cut, like I said. Then the existential fears in the market, it is that even in 2009 that happened, and in 2007 to 2009 the market did not collapse because of housing prices. This is what James Altucher says. He says housing prices had already gone down in 2006 and it was beginning to rise, but most important is people were not aware of that, and the availability of cash went down, and therefore the crash that lasted from November 2007 to March 2009 was caused by something called which is created by an accounting rule there, and not really by the interest rate fall. And the government did perfectly stop it also in March 2009 and let the market go up, right? The only arsenal that any state government or central government or RBI or Fed have in their hand is inflation. So if inflation is high, people will get scared, people will want more cash in their hand, people will be worried about what happens to their investments, so they will invest less. Sounds very contrarian, but that's what he says, and therefore people will put money into safer places or whatever, and therefore so interest rates may not go up so much as to but inflation will. So if inflation is high, it scares people. People will say, oh, of course many of you would be too young to know that in the 1970s there was runaway inflation in the US, there was runaway inflation in India also, right? All these things did happen in the past, so people would be scared and people would say, okay, let me withdraw money from volatile assets like crypto, let me withdraw money from equity, let me withdraw money from real estate. That is what the government is hoping will happen. Will the government reduce inflation? They will make an attempt, but I don't think they're going to be very successful at that. They will succeed because of the threats, and they will not succeed because of the actions, because the market quickly discounts the action. So the market anticipates some threat, so the market falls, and if the action happens, then the market does something called a relief rally, right? So if say aluminum prices go down today and Novelis produces bad results, the immediate aim would be to say, oh my god, I think we should go short on Hindalco. But may not be true, because the Novelis bad results was known maybe 1 week earlier, and the price today, the crash has already been built in. So tomorrow morning or today morning there could be actually a relief rally, rather than saying oh my god, now I should be going short. So if in the relief rally you go short, that's a different thing, but how the market will react is not always predictable, even with the RBI, Fed or whatever. So if RBI reduces interest rates, you think market should go down, but actually market could go up, saying okay, this quarter hike is over. People had already anticipated that, built it into the price, and therefore the price goes up. So you think it's contrarian, it's not. So the Fed, as usual, knows the power of fear, and it will keep scaring you. And we will see inflation. I mean, James Altucher says we will see inflation instantly decline over the next few months, which means the fear really worked, and the Fed will use other manipulations to drive market up, like they did in 2009. They will buy mortgage bonds, maybe even buy more corporate bonds. With inflation declining, there is always a huge risk that interest rates will go down again, right? So again, then you have to see what you have to do with your with the debt portion in your portfolio. Market will remain, he says, market will remain volatile during this period, but it will not collapse, since the Fed does not really want to reduce money supply. It keeps threatening that it will reduce money supply. The dollar will strengthen on some of those threats, and other countries will also want to buy more dollars, and the markets will significantly go up, but it will not go up so quickly, right? Is the Fed stupid? Will they want to really do it? I don't know, but you need to understand that it is the money supply which bothers the market, not the interest rates. If low interest rates could propel countries into action, Japan would not be suffering so much. Since 1989, when was the last peak? The markets have not done anything, and the interest rates are very close to zero in Japan even now, right? Maybe 1%. Inflation has been low, interest rates have been low, but there is not enough growth visible, right? So money supply control is what the reserve banks or the central banks do, and that will mean your equity markets in India also will go down, but in anticipation of this, people may have already sold. So tomorrow it might go up. Remember, it has come down from 62,000 to 54,000. So it has already come down. So will the hike in interest rate actually take the market lower? Maybe, maybe not. Maybe it's already priced in. You need to understand that. Thank you.